Now, I know a lot of you guys still own those little rental properties, and some of you are doing this binary strategy of going into syndications and private placements and also going into some private equity things, but also one foot in the single family homes sector, mainly for like the real estate professional status. If you're not doing it for that, I don't know why you'd be buying little rental properties and all that brain damage and stuff like that. But anyway, if you are, we have Jen Hernandez today, who is a mortgage expert. And it's been a while since we've done a podcast like this and kind of taken the temperature of the current mortgage rates and terms out there. So I thought I'd bring her. But Jen, thanks for jumping on. Give us kind of the lay of the land after 2020, maybe where are rates gone and then, terms gone for like, the single family home, mom and pa.
So a residential loan covers a 1 to 4 unit property, condos, townhouses, that kind of thing. So anything over the 4 units, a fourplex would be deemed commercial. And I deal mostly with the residential. So 2021 and 2021 was just a complete blur. But 2022, we saw within a week, rates like nearly doubled within a couple of weeks. So the rates have trickled down right now, 2026. Really for the last 6 months, we've been kind of hovering in the sixes, the low sixes. You can get lower, you just pay a bunch of points up front. There's definitely lower rates out there, but for the most part, rates are hovering right around six. The forecast that economists say, Fannie, Freddie, Chase, all those big forecasters, is that it'll be pretty flat, and we might see the high fives this year, but I don't think we're expected to have any ginormous drops. I will say, though, as a disclaimer, when rates historically have been super low, so I've done this for 30 years, anytime rates have been super low is when the government is rescuing us for something. COVID we were being rescued. Mortgage meltdown of '08, we were being rescued. The next couple of years we saw super low rates. So right now it's not expected that we're going to have any big, huge downward spirals. So oh, good. Yeah, I like that graph. So yeah, if you want to follow rates, the best thing to do is look at the 7 and 10 year Treasury. That's really where the mortgage bonds pretty much, because the average mortgage is usually around 6 to 8 years. And so those are kind of the treasuries in the bond market that follow most closely the
Yes,
mortgage rates.
I'd like to get your opinion on this, Jen. Like, so when we model our commercial properties, we'll use the Chatham Financial Curve and the CME FedWatch tool. And I tell everybody, you guys have got to bookmark these pages and don't be anal like me and check it every month, but check it once a quarter, see what's going on.
Yeah.
These things have been known to be wrong, but if you guys want some context of who these people are, they're the people who provide the rate cap insurance to big operators. So they got money in the game, like they're not just wild people guessing on YouTube what interest rates are going on. But what do you use kind of as your crystal ball?
I have some internal mortgage specific, something I subscribe to. There's a person in the mortgage industry named Barry Habib who's just been around forever, and we subscribe. He's got a video every morning. He kind of analyzes the market for us. And then there's a couple people on YouTube I follow just for the rates in general. I really rely on my internal subscription because he takes all this and puts it in the residential mortgage world. And actually, someone on YouTube that I watch a lot, do you know Clear Value Tax, Brian? Do you watch him at
Oh
all?
yeah, the Korean dude. Yeah, I think
But I really, really like that channel a lot. He makes it it's always less than 10 minutes. I like that. And just has a really good recap of what's going on. So actually, I usually rely on that and then my other internal scramble. But it's interesting because historically thinks that when the Fed is lowering the rates, oh, that means, hey, I get a call literally minutes later. Hey, the Fed just lowered the rate. My rate must be going down. I'm like, well, it doesn't really work that way. It depends what the bond market is doing. So it's interesting because the last couple of dips in the Fed rate, which is the overnight lending rate that big banks get from the government overnight to cover all their calls for the day. When that has gone down the last few times, our rates have actually gone up. So it usually depends how the bond market is reacting to whatever news is going on. But these charts are great because it can show you the relationship to everything. Let's see what you've got on the bottom one. Which one is that? The
So,
1 month?
so this is what the Fed is actually doing. People are going to probably hear later on this year is at least like 2 or 3 rate cuts of 1/4% or something like that. So that's what's going to people are going to be
Yeah,
hearing. Like you said, the 10-year Treasury is really what
that's the top one.
that's the top one. So
Yeah.
maybe I don't know if you can explain like because there's a disconnect, right? Like they in theory should be totally aligned, right? When one goes down, the other goes down. But why in this weird case is it
This,
opposite?
the Fed rate is the short-term overnight lending rate to the big banking institution, like the all the big investors on Wall Street, like the hedge funds and the Wells Fargos, et cetera. So the Fed rate is the overnight lending rate so that big institutions can cover what they basically overlent, right? Like, oh, it's kind of like floating a check at a bank. So they borrow this money from the Fed overnight to cover their shortages. That's all it is. However, it does influence what's going on. So the Treasury market is literally a function of, are people, investors, are they buying bonds or are they not buying bonds? So the stock market and the bond market are usually inversely related. So when
Usually,
people,
right? Not now.
usually, not always.
Yeah.
When people are, when the stock market's doing great, you're like, oh man, I'm going to buy more Tesla and more Amazon, and I'm going to buy more stock. People aren't buying bonds. They're putting their money in the more risky stuff. The bond market is like a safe haven. It's a fixed coupon. I know what my return is going to be, et cetera. So when you see the stock market freaking out, and literally this can happen day by day. I mean, some politician opens their mouth or someone bombs somebody else or something can happen. And these institutions say, oh my God, we're going to take our money out of the stocks and we want to put it in the safe haven. We want to park it over in the bond market. Okay. So when they're parking their money over in the bonds, whether it's short term, long term, it doesn't matter, the prices are going up and the yield or the rate is going down. And that's where we see jumps in the rates because the rates will most closely, like if you mapped out the Treasury versus, I don't see the mortgage rates on here, but if you could look up any graph, you could just pick the seven, really the 10-year Treasury probably
The 10-year right
versus the
here.
mortgage rates, they will be almost identical in the curvature. So I don't know if that was a good, I'm trying to explain it in kind of as layman terms as I can, but the Fed overnight funds rate, which is that Fed rate that we all hear, is literally a short-term instrument. And the longer-term instrument is the Treasury. The 30-year fixed mortgages are a longer-term instrument. And when mortgage companies are doing their pricing, they're analyzing every morning when secondary marketing departments of all these mortgage companies are saying, oh, what are our rates going to be today? They're looking at the treasuries. They're looking at the longer term 7 and 10-year treasury.
So when a friend asks you, should I get a mortgage today or buy a house today, get a mortgage today because I need a house, or should I wait a year or two? What do you tell
Well, and this does depend on your local market where you live, but in Texas, and I live in Houston, and so our market, we bounce back super quick. Like our values are going down a little bit right now, but we'll bounce back.
Part of that is like inflow migration in Texas, one of the strongest in the country.
And a lot of states, we get a lot of California people, and now there's a big exodus from New York to different places. And but what right now, when the prices are suppressing a little bit, we're seeing them come down, which is great. We've needed this correction because things have been inflated since 2020. I mean, let's face it. So rates are steady, but we're seeing prices come down and we're seeing sellers negotiate in most of our markets in Houston. And so you can get a better price, possibly some closing costs paid to help you maybe buy down the interest rate. And rates are okay. I mean, if you look at a historical average, a rate of 6% is not that bad. And so I would say get in now. If you find the right house, depending on if it's investment or primary, like if it's your primary residence, like this is where your people are going to live, right? Like this is your family. Maybe you need to upsize, downsize, whatever the reason may be. If you find the house that fits your needs, you should do it because you can always refinance the rate in the future, but get in while the values are a little bit suppressed, and then you're going to enjoy that appreciation later on. Because a year from now, we don't know what the values are going to be. I mean, even though our values are suppressed a little bit, we're still slowly growing in a lot of areas around town and a lot of different price points. And that goes also for investment property. So you really need to rely on your local realtor to tell you what's going on in your actual market. Like, is it a buyer's market? Is it a seller's market? Is it flat? What are the months of inventory? I'm really just kind of micro niching down to my local market, but the answer for someone in Ohio might be a little different, depending on how their market is. But as far as the interest rates go, interest rates are not expected for the rest of 2026 to be taking any major reductions, but that could change at any time. Like, who knew that March of 2020 we were going to have this large drop in interest rates? Like, nobody knew. But as far as we can tell, I think rates are pretty steady. They're on the trend downward instead of upward. So that's a good thing. So I would tell people, look, if you find the right property, let's say investment property that's cash flowing you a little bit, if your cash flow is okay on it and you believe it's in an area that's going to appreciate over time, if you're going to buy it and hold it, we're talking about residential property, then I would say yes, go ahead and do it. You're not buying at the top of the market. We're buying hopefully at the near the floor of the market before values start going up again.
Here's my take on the situation. I mean, this is not investment advice. Neither are you giving investment advice either. But
Yes, that's right.
number one, you're gonna have the buy a house to live in if you need the house. Number two, we don't know what the prices are going to be higher or lower, right? So if you take those things out the window, number three is the interest rates. I believe now this is where it's going to throw some people off. The Fed is going to lower rates later on this year. You can look at the CME FedWatch tool. Here I have it projected
Yeah.
out to March, and it does look like it's a few clicks lower. As we were kind of mentioning earlier, the 10-year Treasury is showing a completely different story that the interest rates are not going to be coming anywhere lower. So from that
Mhm.
perspective,
It's marry the house, date the rate. That was a little tune a
yeah,
year ago.
yeah.
Marry the house, date the rate.
So switching topics here a little bit. So when the last time I kind of dipped my toe into this stuff in the 2020 era, you had the 30-year mortgages, right? And they required 20% down. Are there any other changes to this box of lending that people need to fall in to get the Fannie Mae, Freddie Mac? Anything?
I would say that we've seen some really good advances in alternate lending kind of loans, like the DSCR. The DSCR, debt service coverage ratio, where you're just using the rental, average rental income in the area for the property to be your payment. And we don't need all that income documentation. A lot of those rates are actually a little bit better than conventional. The only downside is you'll have a 2 or 3 year prepayment penalty. But if you're buying and holding, like, who cares? Just buy it and just don't pay more than
Uh,
20% to principal every year. I mean, that's the only downside. But my rates on the DSCR, depending on your down payment and credit score, are a little bit better than conventional. So why go through all the gut-wrenching paperwork of like tax returns and W-2s and all that stuff? On the DSCR, we just need to know what the average rent is and that you have some reserves and that you have good credit.
Comparing apples to apples, 20% down payment on the regular conventional stuff, and then 20% down payment on the DSCR. Is it the same?
Yes and no. So it depends on the average rent. So on the DSCR, one of the cons is that we want the PITIA, Principal Interest Taxes Insurance Association, monthly to be the same or less than the market rent. So like, let's say the rent is 2,500 and we get an appraiser to do an average analysis to make sure. So let's say it's 2,500 and your PITIA is 2,600. We want you to put down a little bit more to get the payment under the 2,500 within a range, but you're going to pay a little bit more. So there's kind of a trade-off. So sometimes, because in Texas, our property tax and our insurance are high. So sometimes the math with 20% down doesn't always work. Usually it works at 25, but I hope that answers the question. 20 to 25% down. Sometimes in the lower tax areas, it'll work with 20% down. But other than that, it's pretty much, we usually show people what it would take. And I look like to show them side by side. And if they can provide the paperwork, not a problem, and they're okay with fully documentation, well, then we'll just go conventional if it's true 20% down. Otherwise, we might do the DSCR. And the DSCR allows you to put it in the name of an LLC, which a lot of investors like to do. Whereas conventional, you have to put it in the name of a
Yeah.
person. Like it can't be a corporation.
I always thought like the DSCR was going to be a little bit higher fees. Is that true or?
So the DSCR usually has about 1.5% points baked in. But if you're doing 20% down on conventional, it's kind of the same. So, yes, on conventional, the more you put down, those fees go away. So let's just say you compared apples to apples and you did 25% down on each, and you compared a conventional with a DSCR. The conventional will be better because the points on the DSCR are kind of almost always baked in. You almost always have the 1.5 no matter what your LTV is. So that's where conventional can really win as long as you have an investor that can fully document their income. So that's the key statement is there's a lot of investors that they're like, well, I don't, on paper, I don't make that much. And so they're willing to pay the fee because they're like, yeah, I don't have to produce all that paperwork because I may not qualify, blah, blah, blah. So we just have to really analyze the person. And I can get to the bottom of it usually pretty quickly over which is best. But those are the main things is how can we document your income? Do you want it in the name of an LLC or not? What's the cost structure? What's your credit score? I mean, that's pretty much what we look at. And then we can come up with the two options side by side,
Yeah,
pretty
that's why I
much.
like talking to people like you because there's nothing frustrates me more than somebody working a job. And I'm like, dude, you work here. What do you mean you don't know like that kind of you do this all the time? Don't you haven't you learned from doing this 100 times or 1,000 times? But
Yeah, yeah, yeah.
so double clicking on the debt service coverage ratio loans, there's some subjectivity to like you could get lucky where they might appraise the rents as higher or unlucky.
Yeah.
Right. Generally speaking, from what you've seen as just a bystander, do you think that the appraisals coming back are lower than actual or higher? Or...
I mean, it's all about data, right? Like you're an engineer. It's all about what data's out there. I'm seeing that the rents and the average rents are pretty much kind of the same. I'm not seeing any deals fall through because of that. Appraisals really not coming in either for the price. Like everyone always asks me, how are the appraisals coming in short? And I'm like, not really. I've had a couple this week actually come in a little higher. So the rents in Houston, and here's where again it goes to the market, right? So when you get with a good realtor in whatever market you're in, they've got access in the MLS to that data, usually of what things on the MLS are renting for. And you'll be able to tell before you go in on something if you're living in a dream world on, hey, I need 2,500 a month to make this work, but the average rents are only 2,100, right? So usually you can get to that number before you
Yeah.
start really looking in on a property. But the rents are holding. I mean, I don't see the rents in Houston super decreasing at all because of
Yeah.
all the people that have been on hold waiting for rates to come down. Actually, the rental market is actually pretty good.
So previously on the debt service coverage ratio loans and even the conventional, the borrower needed to show like experience, right? Like they needed to be doing it
Uh,
for a couple of years. Like what does that look like today
so
or
the only time we need experience is when you're trying to count rental income. Let's say you bought a property 2 years ago and you need to show the rental income on your tax return to offset the payment. Like, let's say I'm taking your application today and you're like, yeah, Jen, I own my primary and I have a couple rentals that I bought in the last couple years. You want to use that rental income to offset that debt, right? On the two rentals. So your debt to income ratio is not lopsided. So where we want the experience is we need to see that you've been claiming the rental income on your tax return. But as far as experience, like, hey, we're only going to do this loan for you if you're an experienced investor, actually, I don't ever have a problem with that.
I want to make a key distinction because you guys do a lot of your underwriting in-house, and that's something I always ask because a lot of times mortgage lenders, you see them on LinkedIn all the time, but
Yeah.
there's a lot of like multi-level marketing, like, part-time lenders out there that work for a bigger company. Maybe if you can kind of demystify this world a little.
So basically, I'll try to make it in layers. So there's probably the big 12, like you always hear, like Wells Fargo, Bank of America, Citi, PennyMac. That's where most of the lenders, because there's thousands of lenders, right? They usually funnel the servicing, meaning the payment of your mortgage up to these big 12. And you could go directly to Wells Fargo, whatever, but you're in the machine of just layers and layers of just getting things done, right? And then there's people right below those, the big players. There's people like me that we're direct lenders. We're direct with Fannie Mae and Freddie Mac. We have money. The company I work for has like maybe 100 or $150 million line of credit. So we're constantly lending money, then we'll sell it to Wells Fargo. We're constantly on and off the line, right? But we do everything in-house. When you're a direct lender, you do everything in-house. We order the appraisal, we underwrite, we send the money. Whoever's in the control of the money, that's what you want. Because the layer below me is someone who's not a direct lender. They're what you call a broker. And a broker means like, hey, I'm going to go in the local market and you're close on the street, right? Like, I'm going to get from the realtors or my neighbor or whoever, like, I'm going to lead you to the lending.
They make the intro, like for people who are familiar with sales and marketing, they're just the introduction person.
They're the connector. They're just the liaison between the people that have the money, which is the underwriter, the end all lender, and the client. And they do serve a purpose. It's just important to understand that when you go to someone who's what we call a broker, where they're just finding a connection for where you're going to have the lending. They don't have control of anything. They're not lending the money. They're not in control of the underwriting. They're just connecting the dots for you so that you don't have to. And again, I know several people that are brokers and they do a great job, right? But you increase the chances of not having as much flexibility, or when you're trying to get your deal done, hearing the word like, well, it's with the lender and, I can't really control the timeline and this and that. Whereas if I need something, I was on the phone with my underwriter this morning and I was like 911 and she answered my call right away, right? And we fixed the problem because I'm close to the money. I'm right where the money is. So direct lenders, they can get things done faster, more effectively, usually because they're close to the money. So I hope that explains, hopefully, for your audience what that is. So again, the big guys, you could go to them and walk into Wells Fargo and say, hey, I want to get a loan, blah, blah, blah. Well, you're gonna be a number. You're going to get in the queue and you're going to eventually talk to someone at a 1-800 number, 5-digit extension. That's kind of how that works. Or you come to someone like me, who we are a direct lender, meaning we handle everything, we underwrite, we do all those things. And then after you close, we'll probably transfer your loan to one of those big guys anyway, but you won't even know it. Or you go to someone that's the smaller company broker where they're just kind of connecting the dots for you.
Yeah.
But they don't control anything really, except talking to you, pretty much.
I mean, I know some people are looking for like side gigs and like more retirement work, and you could just become licensed and become one of these brokers and
I
help
mean,
your
you
clients.
could.
And
I'm not a huge fan of that because I think that, you're dealing with people's money. And if you're not really in it, knowing, like, you could really mess a lot of people up if there's a lot to learn.
Yeah, I would agree with that. Like you said, there's some good ones that have a lot of expertise, but a lot of times you get one of these brokers and they send you to the underwriter, and then you get this bait and switch thing where the rate drastically increases on you. And that's why ideally you want to go to somebody like Jen, who is that direct lender. And then if
We're
something
close to the money.
you need, it still need like 6 months of reserves for these properties?
So on these investor loans, no matter what program you use, whether you're fully documenting your income conventional or whether you're doing the DSCR loan or a bank statement loan, any type of investment loan, we do want you to have it's usually going to be anywhere from 3 to 6 months. And the 3 is going to be like for people with better credit and higher down payment. And what reserves means is that after closing, like after you make your down payment and pay your closing costs, what do you have left on deposit to fall back on? We want to know that if you have trouble making your payment one month, you have something you can go liquidate to make your payment. Okay, that's what reserves is. So 3 months would be 3 months of what we call PITIA, principal, interest, taxes, and insurance. So let's say your payment on this investment property that you're going to buy, let's say it's $3,000 because that's easier math for me. So let's say it's $3,000 a month PITI, and you also own other properties. We actually want you to have, let's say it's 3 months reserves. We want you to have reserves on not only the property you're buying, but other properties you own that have mortgage. So let's say you have a primary that has a mortgage. Let's say that's 3,000. And let's say you have another property that's 3,000. So let's say between properties that you own, your mortgage, taxes, insurance, all the things is 9 grand a month. So if the requirement for the program is 3 months of reserves, it's 9 grand times 3 months, that's 27. If it's 6 months, that's 9 grand times six, that's 56,000. So that's why you want to get with a lender really sooner than later to just really see, how do I qualify? What's my credit score? Can I get my credit score up? But get with a lender sooner than later when you're not under the gun, like, oh, I guess what, I'm under property. Let me apply for a loan. No, no, no. Rewind and do it like 3 to 4 months ahead of time so we can see what you qualify for. Can we get your credit better so you can get a better rate, better terms, less reserves? So I that's what I really urge people not to do things last minute, because then you get blindsided. You're not getting the best terms. You're going to lose out on a property. Let's say you find an awesome deal, like, oh my God, this house cash flows. It's at the right price and whatever the things are. And then we pull your credit, or you don't have enough money for reserves, or whatever it is. Like, you just don't want to be blindsided. So we suggest talking to someone sooner than later to just kind of see, get everything on file so you can move super quick when the time comes.
And that's
Yeah.
kind of why you want to have that relationship for the person tapping the underwriter on the shoulder, not some third hand broker who has no
Yeah,
relationship.
credit score. I think what people really need to know is that what you're seeing on your bank app and Credit Karma and Credit Wise or whatever it is not the score that mortgage companies are pulling. There's over 30 algorithms of FICO, and all lenders use the same one. So we use one out of 30. So what you're seeing on your bank app and all that, it's one of the 30, right? But it's usually different. So we want to pull credit. We want to see what it is. We want to give you some free advice if we can, to say, hey, you could bring yourself up 30, 40 points and get into a better tier of pricing so we can get you a better rate. So it really does matter.
What percentage of loans are you doing that's investment property versus the person's primary
I
residence?
probably historically in my 30 years, I mean, it goes in and out. I'm probably like 15%, which, I mean, if I do 200 loans a year, it's kind of a lot.
Of
I do probably 200 loans a year personally. So 10 to
sorry.
15% of that is I usually do 20 to 30 investment properties a year, a couple a month, probably.
Okay.
Sometimes we'll have investors where we'll do 4 or 5 for them at a time, right? I've already got their paperwork on file. So I've dealt with big investors. I've dealt with smaller investors where it's their first time. But historically, it's probably, 10, 15% of my overall business.
Okay. So let me ask you a question on that side of the business. So guys are like $5 to $20 million net worth. And I guess Houston's not that expensive, but if they're buying a $3 to $5 million house, are they buying that with debt, or what do you typically see
No,
sophisticated?
we see them usually they'll get with their financial advisor, and they'll either take a line off their
Yeah.
investments
Or
usually.
security backed line of credit.
Just actually had a guy over the weekend that was looking at a $5.5 million house, and he was going to put half down and then sell his house and do a recast and put a little more down. Sometimes we see those guys that want to leverage everything, but usually we're in Houston, there's a lot of money in Houston, a lot. And so I sometimes I wonder where all this cash comes from, but usually people that are 2+ million, they're either paying cash or they're leveraging their stock accounts usually.
Yeah. Infinite banking is another option. I think that's at like 4 to 5%. So that might actually be better than the security backed lines of credits are
Yeah.
traditionally.
Yeah. And you can get arms in the low fives. So just depending on, and those guys in the higher ranges, they usually are good with adjustables because they're like, yeah, we're going to pay it off in 5 or 8 years anyway.
Yeah,
So
they're
let's,
they're
yeah,
a lot more
let's,
sophisticated and accustomed to
Mhm.
risk, and they understand
Yeah.
the pivot.
Yeah.
So if they get the arm with that, like how much of the $5 million house are they getting leverage on? Like a million,
I mean,
20%?
most of them have at least a 75 LTV, but then there's some that they only borrow half. I mean, it really just does depend. But most, we see a lot of cash in the upper amounts. So a lot of those aren't even financing. They're just doing cash. So
Well,
yeah.
Texas homestead asset protection too, right? You
Yeah.
can't touch what's in my house. Plus, you all
Yeah. Yeah.
got
Yeah.
guns too, so you don't want to touch the house.
That's right. Lots of guns, lots of secret rooms.
Yeah.
But I'm about leverage. I'm like, hey, let me. I like to leverage and I like to get a loan on my house for the most that I can, and then I can invest it in the market. That's personally what I like to do. I'm not a Dave Ramsey fan. I like to invest in other real estate things. I have a couple passive investments that I do, some commercial apartment buildings and stuff, but everybody's just a little bit different.
I mean, that's how I was like when I first got started doing this. Like, you kind of leverage to the tilt because, you have to. But I think that's, when people get on the third floor of the wealth elevator, which could mean $3 million to some, $10 million to others. So huge range. That's why none
Yeah,
of this is financial advice. It's all, everything, everybody's situation is
that's just
personal.
opinion.
It definitely kind of echo what you've been hearing, what you just said is, when you get past certainly 5 million, you start to pay down things and,
Mhm.
keep your silos of cash in your house and things like that that are
And it depends on
discretionary.
your age. Like, actually, today's my birthday. I turned 55. So, like, I'm
Happy birthday.
thinking about things a little differently than when I was 30? And so, just depends. But good talking points. I mean, we've covered a ton of ground. So, if ever anyone wants to reach me, my website's super easy, Loan with Jen, loan singular, LOAN with Jen.com. And happy to have a convo and point you in the right direction. I can lend in 42 states. If it's a state that I can't lend in, I have friends and colleagues in other states that can point you to the right person that'll take really good care of you. So happy to help.
Yeah. And she's got a great YouTube channel. So again, Loans with Jen. If you guys need, just shoot me an email. We can connect you guys over. But yeah, thanks for jumping on, Jen.
Yeah,
It's
that's my
another,
jam.
I just say, well, hey, when you get that eviction and they trash your house, don't come crying to me. Or when you inevitably
No.
get sued and have to
Yeah.
pay 50 grand or 100 grand to fight a frivolous lawsuit, then
Yeah,
all roads lead to LP. But anyway, guys, no financial advice or investment advice here. Right.
that's right. Thanks for having me, Lane. I appreciate it.
Thanks.